Schwab, Fidelity, and Vanguard dominate the U.S. brokerage landscape. Together, they hold over $35 trillion in combined client assets. That number is so large it becomes abstract. So let's ground it with a very specific scenario. What actually happens to your life savings if one of these multi-trillion-dollar institutions completely collapses? We are talking full liquidation, bankruptcy, and a CEO answering questions in front of a Senate committee. That wealth relies on an insurance system whose coverage limit was last updated in 1980, the exact same year the Sony Walkman hit the market. To understand your actual exposure, we have to correct a cognitive error that drives almost all investor panic. A brokerage is not a bank. When you deposit cash into a savings account, you are legally lending it to the bank. If that bank fails, you become an unsecured creditor, fighting everyone else for what's left. A brokerage operates under completely different legal rules. They act as a custodian. Think of a self-storage facility. They hold the key to the unit, but they do not own your couch or your television. Because the firm does not legally own your invested assets, a corporate collapse doesn't mean your money simply vanishes. The doomsday panic is mostly misplaced. But to protect your wealth, there are 3 specific levels of risk you actually do need to prepare for. Let's start with risk level 1, custody risk. The U.S. Securities and Exchange Commission enforces a customer protection rule requiring all broker-dealers to strictly segregate client assets from their own corporate operations. If that segregation somehow breaks down, the Securities Investor Protection Corporation, or SIPC, steps in. SIPC is a private nonprofit backup layer funded by member brokerages to shield your account. We know exactly how this plumbing works in a real crisis because we watched the Bear Stearns collapse in March 2008. The 85-year-old firm bled $16 billion of liquidity in 3 days. Retail clients who held brokerage accounts there lost exactly 0 shares. Their stocks, bonds, and mutual funds were seamlessly transferred over to JPMorgan Chase. The storage facility got a new owner, but the furniture never moved. Vanguard operates on an even safer structure. The company is actually owned by its own mutual funds, and independent third-party banks hold those assets. A traditional bankruptcy at Vanguard is mathematically nearly impossible. For standard equities, the legal framework works exactly as designed. The institution dies, but the assets survive. There is one historical caveat to this fortress. On Halloween 2011, MF Global filed for bankruptcy, resulting in a $1.6 billion shortfall in customer funds. The loophole was the regulatory environment. MF Global was primarily a futures and commodities broker. They operated under CFTC rules, which are entirely separate from the strict SEC guidelines governing your standard stock and ETF portfolio. The firm broke the cardinal rule of custody. They illegally commingled client funds with company assets to pay their own debts. That collapse is not a blueprint for what happens at Fidelity or Schwab. It simply proves that illicit commingling is the singular mechanism capable of creating true custody risk. That brings us to risk level 2, the cash sweep. The ironclad segregation rules we just covered only apply to invested securities. Uninvested cash plays by completely different rules. When you deposit money but don't invest it, brokerages automatically push that uninvested cash across a boundary line into a partner bank. The moment it leaves, SIPC coverage vanishes, replaced by FDIC coverage with a strict $250,000 limit. Take Charles Schwab as an example. Charles Schwab the brokerage and Charles Schwab the bank are distinct legal entities. If the brokerage goes under tomorrow, any uninvested cash sitting in that bank sweep gap above the FDIC limit is legally exposed. The most probable threat to your wealth right now isn't a total institutional collapse. It's holding hundreds of thousands of dollars in an uninvested sweep account, earning rock-bottom interest with an FDIC coverage gap. You can close these gaps with 2 simple structural fixes. First, you can vastly increase your SIPC limit through account capacity diversification. Looking at this chart, you can see how SIPC treats different account types. You secure $500,000 for an individual account, stock another $500,000 for a Roth IRA, and add a third $500,000 for a traditional IRA. That builds a $1.5 million protection ceiling. The second fix closes the cash sweep loophole entirely. You can manually move your excess cash out of the default bank sweep and into a money market fund. Because money market funds are legally classified as securities, this action brings your cash safely back under the massive SIPC protection umbrella. Finally, we have to address risk level 3, investment risk. When Lehman Brothers fell in 2008 and the S&P 500 dropped 57%, SIPC did not bail out investors. No insurance covers your underlying assets losing market value. Market volatility and occasional institutional failures are a permanent feature of investing. But understanding the exact legal plumbing of your accounts prevents the panic-driven decisions that actually destroy wealth.